Our next guest says the fourth quarter marks the start of the Fed pivot trade as we head into 2024. Joining us now, Piper Sandler Chief Investment Strategist Michael Kantrowitz. Welcome. It's good to see you this morning.
Hey, good morning, Scott.
So you think we're just getting started, even though this has been pretty powerful over 6 weeks?
I do. I think the Fed or Powell's kind of thrown in the towel. And I think we've recouped what the market drew down through the summer months. And so we're kind of back to valuation levels and bond yield levels, even a little lower than where we were a couple months ago. So, yeah, I think this starts kind of this is a bit of a paradigm shift to the market.
You're ready for them to come out and say mission accomplished. Some say it's too early.
Yeah, and I think that's going to be an ongoing debate. But given our macro outlook for continued softening of some employment trends and inflation, we feel comfortable that the Fed is done. And, the market certainly does. But, it won't be a straight line down with bond yields. But I think the confidence of investors is that they're done. CPI is not going to come roaring back. And we're going to enjoy a more stable bond yield environment for some time here.
I mean, if it's a new paradigm, what do? Do you pivot along with the Fed to small caps and these other more cyclical areas of the stock market, or do you dance with who brung you?
Yeah, I think it is a bit nuanced. Because while the first 2 months of any rally always looks the same, it's always beta and small caps and risk. What I think is going to be different going forward is that this is not the beginning of a broad-based earnings recovery. And I think that's important. This is really a rally on the back of lower bond yields. And that should not produce the same sustained leadership that you would see after a sharp correction in earnings or the economy driving the market lower. So while it's been risk on, to say the least, in the last 6 weeks, I think that things are going to balance out as fundamentals come back, and we'll start seeing that in the fourth quarter reporting season next year.
Do you put a target on stocks for 24, or at least have an idea of how good you think the equity market can return?
We do our year-ahead outlook call the first week of the year, so we haven't done that yet. But with the multiple of the market at basically 20 right now, with the fear of bond yields, the fear of inflation largely behind us, with credit spreads and the VIX as low as they have been in years, and really high earnings expectations, could the market go up? Of course. Are we going to see another year like this year? I doubt it. And so the way we're thinking about it here is that markets can drift higher, but it's really going to be a stock picker's market this year, where even more so than what we saw in 2023.
There was a good stat from Evercore ISI showing the S&P hasn't declined during a re-election year since 1952 and averaged a 12% gain in those years. You think next year then, given kind of the dynamics you just laid out, kind of won't necessarily match that historical fervor?
Well, the way I look at it is we still have downside risk in the economy. Again, what the market's doing here has more to do with bond yields than it has to do with macro getting better, or earnings getting better. And so what we have today is the Fed. The market thinks the Fed's done. Every single time that's happened in history, the market follows through with some sort of rally. It could be as short as a couple of months, or it could be indefinite. And all that depends on is jobs data. So as long as the employment backdrop and as long as unemployment claims don't go to, let's say, 275,000 or higher, I don't think we're going to see any kind of sustained correction in the market from here. That, to me, is the biggest risk.
On a related note, I did see a note from one of your peers on the street this week that said they don't think March happening. They think June's the first cut. But to get March, they said you'd need sub 50K NFP and CPI sub 0.2. Does that make sense to you?
I think for the Fed to cut in March, I think we'd have to see some pretty evident weakness, and perhaps even a negative payrolls print. So splitting hairs maybe with 50K versus 0 or slightly negative. I think the data will continue to be positive, but trend in a softer. But I think the market's gotten a little ahead of itself in terms of how many cuts we're going to get next year. We do think the Fed will cut next year. But again, it's going to be more jobs-driven than inflation-driven, in our opinion.
Mike, I appreciate it very much. Michael Kantrowitz, Piper Sandler. We'll talk to you soon.
All right. Take care. Happy holidays.
Be well. Yeah, you too.
Still to come this morning, we'll get White House reaction to this morning's PCE data.